Good morning, everyone. My name is Jonathan Levin. I'm a columnist with Bloomberg Opinion, and we are here to discuss Jobs Day. The BLS numbers coming out in about 5 minutes. Joining me today to take them in is Mark Zandi. He's chief economist with Moody's Analytics, and of course, a prolific podcaster in his own right. Also with us today, my colleague Allison Schrager, Bloomberg columnist and senior fellow with the Manhattan Institute. The numbers today are expected to come in at 220,000 additional non-farm payrolls. That would be a big bounce back from 12,000 last month. Last month, I should say October, of course, was affected to a significant degree by a few major storms, hurricanes Helene and Milton, as well as strikes involving Boeing and others. The street's expectation here in the median respondent in the Bloomberg survey is that the unemployment rate will stay at around 4.1%. That would be stable. But again, a lot of moving parts in these numbers. Let me kick it over to Mark Zandi. What does your forecast look like here, and how would you describe the state of the American labor market?
Well, it's good to be with you, Jonathan. Thanks for the opportunity. I think the consensus view is it sounds right to me. I mean, I think we'll get a strong number somewhere between 200 and 250K. That's the change in non-farm payrolls. And that will reflect a bounce back as the Boeing strike ended. I think that was about 35,000 jobs. And we'll get some bounce back from those storms you mentioned as well. Adding that all up, it's probably about 100K. So the underlying rate of job growth, abstracting from the vagaries of the data and strikes and storms and everything else, probably around 100 to 150K in that kind of ballpark. And I'd say that's right down the strike zone. That's enough jobs to keep the consumer engaged and spending and the economy moving forward, but not too many jobs that it would lead to a tightening labor market and stronger wage growth and inflationary pressures and put pressure on the Fed to stop cutting interest rates. So I think it's, as I said, right down the strike zone. It feels, I think it's good. It should be consistent with a very good labor market and economy.
Okay. Given the circumstances, the Federal Reserve wants to make sure that we're really putting this inflation story to bed and that they can continue normalizing interest rates. You think that this is kind of right where we want to be?
Yeah, I think so. If it is in the 250K range, that would be consistent with underlying job growth of 100 and 150K. That would be consistent with a stable unemployment rate, which is just hovering around 4% full employment. Well, of course, we'll get other data points in the report on average hourly earnings, but I think that'll show something that wage growth is around 4%. All of that by itself is consistent with the Fed continuing to normalize interest rates, get interest rates back down to something that's more consistent with the so-called equilibrium rate. So, yeah, I think that the numbers should be consistent with all that.
Okay. As of the close of markets yesterday, Allison, markets as implied by Fed funds futures were figuring there was about 2/3 probability that we were going to get a cut in December. You think this number could move the needle on that? Of course, we still have a CPI report coming next week. So how are you thinking about this number today vis-a-vis the Fed outlook?
I mean, probably not, unless there's like a huge surprise, like either unemployed. It would be surprised if this was a really bad report, which no one expects, then that would suggest there's serious weakening, and maybe that would encourage even a bigger cut, but I think that's unlikely. Or as I said, if it's an exceptionally hot report, then, I mean, it does seem like Jay Powell is sort of opening a room to, as I said, maybe not cut. So if this is an absolutely outrageously good report, maybe that would give him reason to do that. But I think we know the Fed doesn't like to surprise people. If they're teeing up at least one last cut, they're probably going to do it.
Right. And to your point, Fed Chair Jerome Powell was, in the public eye yesterday, I believe, at the Deal Book conference, and he said something to that effect. We're still going to keep normalizing, but we're going to do so cautiously. So here we go. We have the numbers coming out in just a moment, and your number for non-farm payrolls is 227,000. As I told you, the survey had it coming in at 220,000. I will point out 2-month payroll net revisions come in meaningfully positive at 56,000. So you combine that with a slightly above consensus number for the most recent month. I will point out some of the action is really in government payrolls. It would seem the change in private payrolls was a little bit weaker than what consensus had been expecting. Not so big as to maybe make a big deal out of it. Now the unemployment rate U3 does tick up a little bit. It ticks up to 4.2%. As I said, the medium forecaster in the Bloomberg survey had been expecting 4.1%. And just to sort of round out our summary of the data, the labor force participation rate ticks down a little bit. It ends up being 62.5%, down from 62.6%. And it's actually a little bit worse than what the median forecaster was expecting, 62.7%. Mark, from that deluge of data, is there anything that initially jumps out at you as perhaps the most important thing, or what's the story that you read from those numbers?
Well, the story, I think, Jonathan, is exactly what we expected, which is unusual. Usually you get a little bit of the difference. And, there are some differences with some of the more of the detail. You mentioned the unemployment rate notching a bit higher and participation notching a bit lower, and average hourly earnings were a little bit stronger than I would have thought. But, there are a lot of cross currents there that all net out to exactly where you wanted it to be, right down the strike zone. So nothing stands out. I think the headline is we got what we expected, and it shows that the labor market and economy are doing exceptionally well, and have been, and continue to do so.
Right. So let's return to the Fed for a second, Allison. You were just sort of saying that the bar was kind of high for this report to move the needle for Jerome Powell and company. The fact that this is perfectly in line would seem to support that angle, right? Really, nothing much to see here. What's the next thing? Give me CPI. Is that the right take, do you think?
Yeah, I mean, I think this gives them an excuse to do another 25 basis point rate cut, which, I mean, I said less for economic reasons and more for expectation reasons they might want to do, just because when the Trump administration comes in, the economy might get a little hot, or potentially we could have another burst of inflation. So the more they can say, hey, we reached our target, we've done the job, we normalized rates, or at least moved that way, and then inflation took off again for other reasons, the better for them. So, and that would also give them as well a little bit more space to do that. So I think, as I said, they're going to feel good about this report. It's, I'm curious though what Mark Zandi thinks is going on with the labor force participation going down and the unemployment rate going up, because usually don't those go in opposite directions? Like we see unemployment ticking up a bit because more people have joined the labor force.
Yeah, I don't, Allison, you're right. I don't know unless I take a closer look at the data. I'm not sure what's going on. The only thing I'd say is I wouldn't read too much into it. The household survey, very small survey. I think it's 60,000 households across the country. It bounces around a lot. It's not really accounting for, the surge in immigration that we've experienced, and now the deceleration in that immigration, given the curtailment of asylum seekers into the country. So there's a lot of things going on in that data. So I'm not so sure I'd read too much into it. The bottom line is unemployment's low, hovering around 4%. That's full employment, and 62.5% is, that's a pretty good participation rate. I mean, kind of consistent with where you thought it would be if you were forecasting the participation rate, several years ago before the pandemic. So it 1 month here, 1 month there, I'm not so sure it really makes that I don't think this makes a difference. I think when you take a step back and take a look at the data, everything feels like it's sticking roughly to script.
Oh, look at that.
Yeah, I did want to briefly take you all through some market reaction. The knee-jerk reaction was a positive one. This is a market where yields, borrowing costs had moved up meaningfully, sort of in the wake of the election of President-elect Donald Trump. And off the back of this report, even though it was kind of in line, you did see yields move down, but it was kind of just a knee-jerk reaction kind of thing, as we often see, because you see the intraday chart. This is the 10-year Treasury note, the yield on the 10-year Treasury note. You saw that it dropped down pretty meaningfully, but it's almost come all the way back up. Pricing right now is about 4.17%. The logic here, as always, is yields down, price up on your 10-year Treasury note. So, at the margin, it seems to be reflecting maybe a little bit more of an expectation that the Fed will go ahead and cut here, but as we've been discussing, doesn't seem to firmly move the needle in one direction or the other. I did want to, real briefly look at the breakdown of the non-farm payrolls, where they're coming from. I've got the BLS's table up here on my laptop, so excuse me for looking away from the screen. But so again, you had 227,000. That's your top line number. 194,000 total private. You break that down, and most of those, sort of not surprisingly, coming from private service providing industries. You do see sort of a bounce back in manufacturing jobs. Moving further down, retail trade was a bit weak. Some people were saying that might possibly be like a thing with the seasonals, in the sense that Thanksgiving came particularly late last month. So people were flagging that maybe that was something we wanted to look out for. But retail trade looks relatively weak for November, if you take it at face value. And then another one that I've been finding kind of interesting to look at recently, construction. You end up adding, this is the top line number for construction. You end up adding 10,000 non-farm payrolls jobs in construction, which includes a lot of stuff. It's not just residential property construction, but I do find that surprising, Mark, because new housing starts have been pretty weak for a while. You've had this mortgage rate situation weighing on affordability. Do you think that construction jobs are going to roll over at some point here and maybe be a risk to these non-farm payrolls numbers?
Probably not. I mean, I think on the single family side, single family housing construction, obviously there's a lot of demand. Builders have done a good job of effectively cutting price on new homes through interest rate buy downs to keep buyers engaged in selling homes. And so that should support, continued construction. There was also obviously a significant backlog of building that developed during the pandemic that it's now starting to wind down, but it's still, if you look at the backlogs, the homes that are in the pipeline going to completion, still very high by historical standards. So that should help continue to support construction activity and construction employment. Maybe a little bit of weakness dead ahead as we move into 2025, 26 on the multifamily side. There, vacancy rates have pushed up a bit, particularly at high-end multifamily. And we are starting to see the pipeline for completions abate. And as you pointed out, new starts are down, so that we might see some weakness there. But that should be offset by continued strong activity in outside of housing. And, you know, one reason why the construction industry has done so well is the infrastructure legislation that was passed a couple of years ago has really juiced things up. The CHIPS Act has helped to support the construction of, you know, various types of manufacturing facilities, even the Inflation Reduction Act. And then, of course, you've got all the construction for data centers going on related to artificial intelligence. So you net all that out, and it seems to me that construction trades should continue to be a source of growth, a small source of job growth, but a continued source of growth. By the way, just a quick tangential point. You know, historically, you know, when you see interest rates rise as we have over the past 3 years, it's the construction industry, real estate that gets nailed, and that leads the economy into recession. And the fact that that did not happen this go around for the reasons I articulated is one key reason why we avoided recession. The construction trades held up and didn't even really continue to add jobs, let alone lose jobs.
Right. Okay. Let's get a little bit into macro grab bag here. One thing that caught my attention. You had a really compelling tweet the other day, Mark, where you underscored the valuations in financial markets, broadly speaking. And I wondered if you would unpack that for us a little bit here. Is that one of the big macro risks that you see in this otherwise pretty rosy picture?
Yeah, well, the economy is doing really well. I'd say the word is exceptionally well. By any standard, today's jobs numbers are just consistent with that, that narrative. So, valuations in asset markets, stock prices, credit spreads in the corporate bond market, real estate, single family housing values, all, should be high. The economy's good. Companies are making lots of money. Cash flow is strong. They did a good job. Businesses did a good job locking in the previous low interest rates, and so the run up in rates really hasn't translated through and affected their earnings. So they should be high, but they're very high, and they continue to move higher in the context of higher long-term interest rates. The 10-year Treasury yield is up a lot, compared to where it was a couple months ago. I think asset markets, and I'm speaking broadly, obviously. I mean, there's a lot of nuance depending on the market. Each has their own story. But broadly speaking, asset markets feel like they're going from being richly valued to overvalued to bordering on frothy. I don't think we're in the speculation stage yet. That's not what we're seeing here, but things are very richly valued. And thus, things have to go absolutely positively right. Nothing can go off script. And goodness knows, in 2025, there's going to be a lot of changes to economic policies. And in my view, that is a prescription for something not going right. And so, yeah, I think asset markets are poised for potential correction and not a decline and come right back as we've been seeing in recent corrections, but, correcting and staying corrected for a while. And that is a risk, I think, to the broader economy in 2025, 2026. Not my baseline, but I think a risk that everyone should really consider carefully.
Yeah. What do you think about that, Allison? I mean, we've just seen Bitcoin go sort of bananas. There's this, rather speculative Trump trade in a handful of sort of meme-ish stocks going on. A phrase that I hear thrown around a lot since election day is animal spirits. Animal spirits. The election of Donald Trump is unleashing animal spirits, and I'm never quite sure what that means exactly. Maybe it means that the famous vibe session is behind us. But what do you make of animal spirits versus the idea that a lot of asset markets are already sort of rich, if not frothy?
Well, I think they already, were pretty hot even before Trump won. I guess the optimistic take is markets are excited about the prospects of potentially even lower corporate tax rates, about deregulation. I don't know what their stance is on inflation. I think it's hopeful it'll be used more as a negotiating tool than an across the board large tariffs. So, and I mean, there are aspects of the Trump agenda that, could pour more fuel on this fire. So, I think but I think it's sort of, for me, raises a big question. If are where interest rates are right now, or at least the Fed funds rate is, or their policy rates are, is that even contractionary? I mean, it's hard to say that. I mean, maybe if you squint hard enough, you can see higher rates having some impact on a sort of small cap businesses that are trying to roll over their debt. But it's sort of saying to me, said, like, I could justify a rate cut just more for expectation reasons, but it's hard to justify for economic reasons, because I think it's hard to sort of argue right now that rates right now are having a contractionary effect in the economy, not when Bitcoin's up to $100,000.
Right. Well, this is the famous argument about R star, right?
Mhm.
The elusive number that constitutes the interest rate that is neither stimulating nor holding back the economy, and nobody ever knows precisely where it is. And the Federal Reserve says that it wants to get back there at some point, but it doesn't really know where that number is. I follow closely, the New York Fed's survey of primary dealers, and they sort of ask people where they think interest rates will settle in the long run. And the trend has sort of been for those estimates to have been moving up over the past 12 to 18 months, I would say. But they've sort of been hovering in the low threes at this point. Prior to this whole inflation episode, a lot of people thought it was closer to 2 even. What do you make of that argument that Allison just laid out, Mark?
Well, I think the equilibrium rate, that so-called elusive R star, and it is elusive, and I think we should be humble, it is not written in stone. It's not immutable. It changes, and it's higher today than it was pre-pandemic for lots of different reasons. I think most significantly, U.S. households and businesses were able to lock in the previously record low interest rates. So the run up in the federal funds rate hasn't translated through into higher interest expense for households and businesses. Something that is unique to the U.S. economy, or at least special about the U.S. economy compared to the rest of the world, where liabilities of households and corporations adjust a lot more quickly. So that would argue for a higher R star than what it was pre-pandemic. Pre-pandemic, the consensus view, and I think roughly right, 2%. If you told me today the equilibrium yield is 4%, I don't think I'd argue with you. But that we're still above at 4.75%, which is where the funds rate is today. That's still above the equilibrium rate. And I do think monetary policy is working to slow economic growth. It has slowed economic growth at least in terms of what it means for the labor market. The labor market has cooled off to a significant degree compared to where it was. And so I do think it is contractionary, but I don't think it's 3%. But I think that's where we're headed, and that goes to, again, back to where I started. The R star is not immutable. It's not written in stone. It will move, and it will move back down over time as the factors that pushed it up continue to abate. So I think that survey you mentioned with the equilibrium rate around 3 in the long run is probably right. But it's at the moment it's higher than that. It's about 4. But again, let me end by saying what I said earlier. We have to be humble about this. It's very difficult to figure out what R star is. Certainly what the forecast of it should be.
Right. And to your point, if you get in the weeds on this stuff, you really have to make the distinction between what people consider long run neutral and what people consider short term neutral.
Yeah.
And this is a very unique economy that we are experiencing here.
Rogoff has a nice paper. Sorry to interrupt. I just want to draw attention to it. I think it's at NBR right now, about R star over the last 20 years, and argues that it maybe wasn't even that far down. Like, it wasn't as low as we thought it was even in the 2010s. And so thinking about it, around 3% might just be generally where it is.
Yeah. All right. Well, I do want to cycle back to some data here. because we have our updated tables on the Bloomberg terminal, and we were talking about the unemployment rate and sort of what's driving it earlier in this conversation. So I wanted to actually unpack that for people, right? So from October to November 2024, you do see this unemployment rate tick up. What is actually driving that move from 4.1% to 4.2%? So the contribution from job leavers increases a little bit. The contribution from re-entrants to the job market, that does tick up a little bit. The contribution from new entrants also up a little bit. Permanent job losers, again, they're contributing here to the unemployment rate in a more meaningful way than they were, but it's still a relatively small piece of the puzzle. This is not a labor market that is suddenly seeing a wave of layoffs, not even close. So of the 4.2%, you're only looking at a contribution of 1.1% from permanent job losers. Temporary layoff ticks down a little bit. I did want to get into some of the other transformations here and see if anything jumps out at anybody. So let's do education. This is always compelling, especially coming out of this election, which raised many questions about how politics and the economy have been interacting here. So U3 unemployment, sort of the contributions sort of stable for those with less than a high school diploma. More of the unemployment rate this month than last month is explained by those who have a high school degree but nothing more, no college. And that's pretty much the story. Less of this unemployment rate this month was explained by those who have a bachelor's degree or higher. A lot of these are really, really small numbers, really, really small wiggles in, a survey that, as Mark pointed out, is not terribly large, can be noisy from month to month. Mark, do you make anything of these numbers under the hood here?
Well, sorry, Jonathan, I don't see the same table you are, so I can't see the detail, but just listening to what you're saying. No, it's okay. Just listening to what you're saying. No, I think, as you said, they're wiggles. So I'm not sure I'd read too much into it. I mean, bottom line, the unemployment rate's been hovering around 4%, for 2 years? I mean, across every demographic, just age, gender, ethnicity, educational attainment, coast to coast. I live here in Philadelphia. The unemployment's real low. You go to Chicago, the unemployment's low. You go to San Francisco, the unemployment's low. I mean, participation rates, they've recovered after since the pandemic, and controlling for demographic trends are right where they should be. Employment to population ratio is another way of kind of gauging where the labor market is in terms of full employment. It's exactly consistent with full employment. I mean, Jonathan, this is like, we should soak this in. I mean, it's like rare that the economy is performing as well as it's right now, and the labor market is just exactly perfect, picture perfect. So I wouldn't read too much into the wiggles. I'd take a step back and take a look at the entire painting. Don't get lost in the pixels. Right. Take a step back, take a look, and go, okay, this all feels pretty good. So I'd say President Trump is inheriting a fabulous economy from President Biden. It's like it couldn't be any better.
Right. Exactly. It's going to be wild in 20 years to tell the next generation about how, we had an amazing stretch of 4% unemployment, but we spent most of that time worrying about how it was going to go up any month.
Exactly.
Well, I do
Yes.
have a question. Like you pointed out that we have so many construction jobs from building all these factories in part from IRA and CHIPS Act. But I mean, at a certain point, we've built all the factories that we need to build. I mean,
Oh,
does something
Allison,
about that
we
run
got a
out?
long way to go, my
Mhm.
friend. A long way to
Mhm.
go. Yeah, I'm going to be retired when we run out of the need for factories. I mean, there's a lot of manufacturing activity that needs to come back home, for lots of different reasons, and will come back home. And so I'm not worried about that. And construction jobs, again, we're talking thousands, maybe a 10,000. We're talking hundred thousands of jobs every month. So it's important, but it's not the most important aspect of what's
Mhm.
going on in the labor market. But we need bring it on. We need a lot more factories, a lot more data centers, and everything else that drives the manufacturing train.
All right. Well, I'm going to close it out right there on that relatively positive note from
That's
Mark
not relatively,
Zandi, Chief.
Jonathan. That's a positive note. That's a positive note. That's not relatively positive. That's positive.
Yes, positive,
Yeah.
positive.
Positive.
What
Yeah, there you go.
what
Yeah.
what was your adjective for describing this economy, Mark?
Exceptional. You should write that down.
Exceptional.
Exceptional. Exceptional. Yeah.
Exceptional. All right. Well, I'm gonna leave everybody with Mark Zandi's exceptional economy. Thank you very much to Mark Zandi, chief economist with Moody's Analytics. Thank you, Allison. Your change in non-farm payrolls for November is 227,000. Your unemployment rate in the United States of America is 4.2%. Thank you very much for joining us, and we'll be back here for CPI next week. Thank you.